One of the most interesting conversations I've been having lately with clients and investors is not about chasing bigger deals, higher cap rates, or more aggressive returns. It's about simplifying their portfolios while still preserving wealth, passive income, and tax advantages of real estate. Because after years of owning apartments, retail centers, or management-heavy properties, a lot of investors eventually reach a different phase of life. They're tired of operational headaches, tired of renovations, tenant turnover, maintenance issues, and constantly solving problems. But at the same time, many of them do not necessarily want to sell outright either, because once you sell highly appreciated real estate, now you may be facing major capital gains taxes, depreciation recapture, and a significant tax event that can dramatically reduce the equity you spent years building. So the conversation starts shifting from how do I maximize yield to how do I preserve wealth, simplify ownership, maintain passive income, and still keep the tax advantages of real estate. And that's where long-term corporate-backed triple net investments like this 7-Eleven in Long Beach, California, start becoming very interesting. This is closer to a long-duration passive income stream backed by durable real estate, a necessity-based business, an absolute triple net lease, and almost zero landlord responsibilities. Because there's a major difference between actively operating real estate and owning a property where a corporate tenant handles virtually everything while rent continues showing up every month. Welcome to the Commercial Real Estate Deal Room. I'm Mercedes Shaffer, commercial real estate broker and business broker, and I help investors evaluate commercial real estate opportunities beyond the glossy brochure, understanding not just the upside, but the underlying risks and how the investment fits into their long-term wealth and passive income goals. And today, I want to break down why some investors intentionally transition capital into lower cap rate, mailbox money, triple net properties like this 7-Eleven, and why, depending on the investor, this strategy can actually make tremendous sense long term. The property itself is a brand new construction 7-Eleven convenience store and gas station located in Long Beach, California. The asking price is $5.79 million with a 4.75% cap rate. Structurally, this is exactly the type of asset many passive income focused investors look for. The property features a brand new 15-year absolute triple net lease with a corporate guarantee from 7-Eleven itself. That matters because absolute triple net means the tenant handles the taxes, insurance, maintenance, roof, and structure. Essentially everything. You're no longer worrying about maintenance calls, unexpected repair bills, rising insurance costs, or operational headaches. In many ways, you're simply collecting a rent check from a corporate-backed tenant under a long-term lease. And for a lot of investors, that level of simplicity becomes incredibly valuable. The lease also includes rent increases every 5 years, which matters in an inflationary environment because one of the biggest risks in long-term investing is owning income streams that never grow. Now, with that said, the 4.75 cap rate is obviously compressed. This is not a high yield investment. If your primary objective is maximizing day one leverage cash flow, there are almost certainly higher yield opportunities available elsewhere. But again, that's not really what this buyer profile is optimizing for. One thing I think newer investors sometimes misunderstand is that different investments solve different problems. A younger investor may prioritize aggressive appreciation, heavy value add opportunities, and maximizing leverage. But investors who already have substantial equity built up often start thinking very differently. For example, this type of investment can be a very good fit for someone who owns a portfolio of older multifamily properties and has built significant appreciation over the years, but no longer wants the operational burden that comes with actively managing real estate. Maybe they're tired of tenant turnover, maintenance issues, contractors, insurance increases, and the constant complexity that comes with older properties. At the same time, they may not want to trigger a major taxable event by selling outright and paying significant capital gains taxes and depreciation recapture. So instead, some investors complete a 1031 exchange into more passive investment structure. And that's exactly where properties like this start fitting into the conversation, because now the investor preserves equity, potentially defers taxes, simplifies ownership, maintains passive income, and still benefits from real estate ownership over time. And over the long run, that can become extremely powerful when you combine appreciation, loan paydown, depreciation, and long-term passive income. Again, every investor situation is different, so it is important to speak with your CPA or tax advisor before making investment or tax-related decisions. But these are exactly the kind of strategic portfolio conversations I'm having with a lot of investors right now as they transition from more management-intensive real estate into more passive ownership structure. Now let's talk about the actual business behind the real estate, because when you're buying a lower cap rate investment, brand durability matters enormously. And this is one of the reasons why 7-Eleven works so well within this mailbox money strategy. This is not a trendy concept dependent on hype. This is daily necessity retail. Coffee, fuel, snacks, drinks, and quick convenience purchases. That matters because necessity-based businesses tend to remain more durable during economic shifts than highly discretionary concepts. And 7-Eleven also has tremendous scale with more than 13,000 locations in the US and Canada and over 78,000 worldwide. And importantly, this is a corporate guaranteed lease. That significantly changes the risk profile compared to a small franchisee-backed deal. Now, does that eliminate risk? Absolutely not. Convenience retail still faces inflation pressure, labor pressure, fuel margin pressure, and changing consumer behavior. But relative to many restaurant concepts, I actually view strong convenience retail in dense infill markets as fairly durable long-term, especially in Southern California locations with significant traffic counts and dense surrounding population. This property also sits near Interstate 710 with over 200,000 vehicles per day nearby, surrounded by major national retails including Starbucks, McDonald's, CVS, AutoZone, Taco Bell, Wendy's, and O'Reilly's Auto Parts. That surrounding retail strength matters because it reinforces the long-term viability of the corridor itself. Now here's the part I think most people overlook. This type of investment is often less about maximizing immediate returns and more about long-term positioning and lifestyle design. Because eventually, some investors stop asking, how much can this property make? And start asking, how simple can my life become while still preserving wealth and maintaining passive income? That's a very different conversation. And I think that's why these types of triple net properties continue attracting strong demand despite lower cap rates, because investors are paying for simplicity, predictability, reduced management burden, corporate credit, durable locations, and easier ownership. Then, over time, many investors continue building wealth through appreciation, and depending on their long-term goals, may eventually choose to do a cash-out refinance, allowing them to pull out liquidity in a potentially tax-advantaged way while continuing to own the asset and collect passive income. That can become a very attractive long-term strategy for certain investors, especially professionals, retirees, or investors focused more on wealth preservation than aggressive growth. Now, with all of that said, I do think investors still need to remain disciplined, because one of the biggest risks in trophy triple net investing is overpaying for perceived safety. So overall, who is this opportunity actually a good fit for? If you're looking for aggressive value add upside, high cash on cash returns, major repositioning opportunities, or substantial day one leverage cash flow, this probably is not the right investment for you. But if you're a 1031 exchange buyer, an aging landlord, a busy professional, someone tired of management headaches, or an investor prioritizing stability and simplicity over maximum yield, then this type of investment makes a lot of sense, especially because the lease structure is strong, the tenant is corporate backed, the real estate appears durable, and the ownership structure is extremely passive. The biggest trade-off here is straightforward. You're paying a premium for predictability. And whether that premium makes sense depends entirely on the investor's goals. What do you think? Does a 4.75 cap rate make sense for a corporate guaranteed 7-Eleven in Long Beach if the goal is passive mailbox money income and long-term wealth preservation? Let me know in the comments. And at the end of the day, every commercial real estate investment involves trade-offs. Higher yield usually means higher risk, more management burden, and greater volatility. And lower cap rate, which we call mailbox money investments like this, typically prioritize stability, simplicity, and ease of ownership. Neither strategy is automatically right or wrong. The key is understanding what actually aligns with your stage of life, financial goals, and long-term investment strategy. If you're actively evaluating triple net investments, considering a 1031 exchange, or trying to determine whether transitioning part of your portfolio into more passive commercial real estate makes sense, you can contact me through the link in the description below. And if you want more breakdowns covering triple net investing, passive income strategies, tax-efficient commercial real estate, cap rates, and long-term portfolio positioning, make sure you subscribe to the Commercial Real Estate Deal Room. I'm Mercedes Shaffer. I'll see you in the next deal.